Understanding cost segregation, a powerful tax strategy. As a property owner, you're likely familiar with depreciation. It's a valuable tax deduction that allows you to recover the cost of an asset over its useful life. But what if you could accelerate those deductions, boosting your cash flow and reducing your tax burden in the early years of ownership? That's where cost segregation comes in. Traditional depreciation methods often lump all building components together under lengthy recovery periods, typically 27.5 years for residential rental properties and 39 years for commercial properties. Cost segregation, however, takes a more surgical approach. It identifies and classifies individual building components based on their specific depreciable lives, often resulting in shorter recovery periods and larger deductions up front. This strategy can be particularly beneficial for new construction, renovations, or acquisitions of existing properties. By accelerating depreciation, you can free up significant cash flow in the early years of ownership, reinvesting those funds to further grow your wealth. In essence, cost segregation is a powerful tool for maximizing your property's tax advantages, putting more money back in your pocket where it belongs. The benefits of cost segregation: accelerated depreciation. The primary advantage of cost segregation lies in its ability to accelerate depreciation deductions. By breaking down a building into its individual components, cost segregation allows you to depreciate certain items over shorter time frames. For example, carpeting, furniture, and appliances, classified as personal property, have a 5-year depreciation period. Land improvements, such as landscaping, parking lots, and sidewalks, fall under a 15-year recovery period. These shorter depreciation periods translate into larger deductions in the early years of ownership, significantly reducing your tax liability and boosting cash flow. This accelerated depreciation offers a powerful incentive to invest in real estate, knowing you can recoup a significant portion of your investment much faster. Identifying depreciable assets: personal property versus real property. A key aspect of cost segregation involves accurately classifying building components as either personal property or real property. This distinction is crucial because each category has different depreciation rules and recovery periods. Personal property encompasses items that are not permanently attached to the building structure. This includes furniture, fixtures, equipment, and even certain structural components that can be easily removed or replaced, like removable wall partitions. Real property, on the other hand, refers to items that are permanently affixed to the building or land. This includes the foundation, walls, roof, and other structural elements. By carefully analyzing the building and its components, a qualified cost segregation professional can identify all eligible personal property and land improvements, ensuring you maximize your depreciation deductions. Maximizing deductions, bonus depreciation, and Section 179. Cost segregation becomes even more powerful when combined with other tax incentives like bonus depreciation and Section 179 expensing. These provisions allow you to deduct even larger amounts in the year you place the property in service. Bonus depreciation enables businesses to deduct a significant percentage of the cost of qualifying assets immediately, rather than depreciating them over time. The bonus depreciation percentage can vary depending on the year and type of asset. Section 179, expensing, on the other hand, allows you to deduct up to a certain dollar limit of the cost of qualifying equipment and property in the year you start using it. This limit is adjusted annually for inflation. By strategically combining these provisions with a well-executed cost segregation study, you can significantly reduce your tax burden in the early years of ownership, freeing up even more cash flow for reinvestment or other financial goals. Timing is key when to conduct a cost segregation study. The optimal time to conduct a cost segregation study is generally during the first year of ownership, ideally before you file your tax return for the year the property is placed in service. This allows you to take full advantage of accelerated depreciation deductions and any applicable bonus depreciation or Section 179 expensing. However, even if you've owned the property for several years, it's not too late to benefit from a cost segregation study. You can amend your previous tax returns to claim missed deductions, potentially receiving a significant refund. It's also worth considering a cost segregation study after a major renovation or improvement project. These projects often involve significant expenditures on personal property and land improvements, making them prime candidates for accelerated depreciation. Conclusion: unlock your property's tax advantages. Cost segregation is a powerful tax strategy that can unlock significant savings for property owners. By accelerating depreciation deductions, it reduces your tax liability and boosts cash flow in the early years of ownership. To determine if cost segregation is right for you, consult with a qualified cost segregation professional. They can analyze your specific situation, identify potential deductions, and help you maximize your property's tax advantages. Remember, knowledge is power when it comes to taxes. Take advantage of the tools and strategies available to keep more of your hard-earned money working for you.